introduce the panel. Thank you.
Great, thank you. So again, I'm Josh White. I am the acting Chief Economist and Acting Director of the Office of Economic and Risk Analysis at the PCAOB. So we're the economists in the building. Before we begin, let me offer a disclaimer. The views that I express today are my own and do not necessarily reflect the views of the PCAOB, the board, or members of the staff. All right, so you have one of the documents that you got is a handout, and it's going to give a summary, a very concise background factual information on Sarbanes-Oxley. And so to set the backdrop for this panel, in 2002, following a lot of major corporate scandals, Congress passed the Sarbanes-Oxley Act, or SOX, as we've come to know it, which established new provisions related to internal control over financial reporting. So Section 404 has probably been one of the most talked about sections of SOX. Under Section 404A, managers must assess the effectiveness of their internal controls on financial reporting, and I will call that ICFR from this point on, because that's a mouthful. Section 404B has probably been the more contentious of the two sections, and this is where the company's auditor must attest to managers' assessment of their ICFR. Now, over time, there's been a series of exemptions and refinements. Some were temporary, some were permanent, and you'll see in the handout a summary of those key events. And so I'm not going to walk through those individually now, but as we talk to our panel, they may reference some of those specific changes. This past June, the House Financial Services Subcommittee on Capital Markets held a hearing on reassessing SOX. Much of the discussion centered on Section 404B, particularly the cost of the auditor attestation and the scope of the exemptions. So today, our focus in this discussion is going to be on what does ICFR mean for investors. Our goal is definitely not to relitigate the discussion in the House. It's on YouTube if you want to go watch it. It's there to be replayed. But we want to step back and think about, from an investor perspective, why does ICFR exist? Why was this the solution coming out of SOX? What evidence is out there on the costs and benefits of ICFR? How do investors actually use this information? And whether there may be ways to calibrate within the existing framework of SOX. All right, so with that context, let me introduce our panel, and I'm going to go in alphabetical order. So Professor Abigail Allen is an associate professor of accounting at Brigham Young University's Marriott School of Business. Professor Allen is a certified public accountant and a former auditor. Her research examines the political economy and economic consequences of accounting regulation, including mandates like ICFR. Professor John Coates is the John F. Cogan Jr. Professor of Law and Economics at Harvard Law School, also serves as the Deputy Dean and Research Director of the Center on Legal Profession. Professor Coates has written extensively on corporate governance, securities law, financial regulation, including work synthesizing research on SOX. Professor Maureen McNichols is the Mariner S. Eccles Professor of Accounting and Public and Private Management at Stanford University. Professor McNichols' research examines financial reporting and its role in providing information to investors, and her work has covered a broad range of topics, including earnings management and the role of auditors in financial reporting quality. And we also have Mr. Frank Watanabe, who's the president and CEO of Arcutis Biotherapeutics, which is a public biopharmaceutical company focused on developing treatments for serious dermatological diseases. Mr. Watanabe also serves as the vice chairman of Biotechnology Innovation Organization, or BIO, which represents over 1,100 biotech organizations. All right, so we're very fortunate to have such a strong and diverse set of perspectives. So to begin, I first want to talk about the history and the purpose of ICFR. And so let's set the foundation. After the scandals of the early 2000s, SOX established new provisions around ICFR. So Professor Coates, could you start us off with why Congress created these requirements and what was the intent behind ICFR?
See if I can do this very, very succinctly. So one maybe year that ought to be on here, or a couple of years that predate 2002, back in the 70s, it was discovered that many large companies were permitting employees to spend money in ways that were unauthorized, including by bribing domestic and foreign officials. And so the Foreign Corrupt Practices Act was passed, and that act actually requires public companies to have controls And that really is an important backdrop to this discussion because SOX did not invent the control idea, did not invent control regulation. And even if it were passed away tomorrow, even if it were repealed tomorrow, the FCPA would still be there and would mandate some of the same kinds of things that ISCR ultimately picks up on. All right. Now, more specifically, SOX was passed because in the 90s, there was an ever increasing number of restatements, some innocent and inadvertent or mistakes, some connected to outright fraud that led to very high profile bankruptcies, among other things like Enron, WorldCom, and Parmalat for our Italian friends, if any in the room, just to name a few very famous examples. And the pattern was not just limited to a few, but indicated, the best studies of the period suggest it was systematic and that the audit profession's involvement in helping audit financial statements was not keeping pace with either the incentives or the ability of large and larger, ever larger public companies to cheat, to put a fine point on it. It was nearly unanimously passed, Sarbanes-Oxley. I think there might have been one or two dissents, but basically the kind of law that rarely comes along. And the PCAOB was created, and that probably was the most important thing, not to cater to you guys, but it's true that the law did. So the controls that we're going to talk about were also a component of that, aimed specifically at taking the pre-existing requirement controls and linking them to the financial statement process, and then adding the thing I'm sure we'll spend time talking about, a role for not only management to say something, to disclose their own view about their own control system, which arguably was already in the law to some extent, but in any event formalized it, and then added the auditor attestation piece. So to be clear, Sarbanes-Oxley, and I'll end with this, is it's a disclosure statute insofar as we're focused on controls. ICFR. Companies are permitted to have weaknesses in those control systems. Many do, in fact, as long as they disclose them. And auditors can bring those to their attention. And the companies can say, yes, thank you very much. We understand we could be better, but we actually don't think it's worth spending the money to fix that weakness. So we're going to disclose the weakness and move forward. So it's an important feature of this environment. It's not the case that there is a straight line between the statute and a control or a control expenditure. There's a series of intermediate decisions that have to be made. Many companies do choose to spend money to fix problems because they'd rather not disclose the weaknesses because it would tend to affect the way their investors view them and might affect the cost of capital. But that's a choice they have. It's not something that's prescriptive in the law. So that's the backdrop.
Great. Thank you, Professor Coates. That's definitely a helpful way to frame the issue. Professor McNichols, let me turn to you. Could you describe a little more on ICFR and really what does the academic evidence show about the outcomes, things like company performance or financial reporting quality?
So I'd like to set the evidence on the costs and benefits of ICFR in a broader context, which is, of course, that financial reporting is a crucial tool in corporate governance, and that this role really emerges from the agency conflict between investors and managers, and reporting by the firm to investors is a crucial aspect of accountability. So financial reports are playing this crucial role, and despite arguments that financial statements may be less relevant to investors, several studies over the last several years have shown that the role of financial statements in informing investors has actually grown. The magnitude of price response at earnings dates has grown substantially, increased considerably since the early 2000s. Evidence in terms of how financial statement amounts, book value of equity, other components of asset values increasingly are tied to valuation. And so I just want to underscore the importance of the controls in the context of the importance of financial reporting and having high quality financial statements. And I also want to mention that I see the financial reporting ecosystem as multi-layered. The oversight is multi-layered. And the firm and its controls are really the first line of defense against misreporting and misappropriation. Then we have auditors, then regulators such as the SEC and through their Division of Corporate Finance comment letter process, their investigations, and of course the PCAOB's inspection of audits. So where internal controls are weak, the burden of detection becomes that much greater because successive monitors typically have less access to the relevant information that is clearly within the firm. So now turning to the benefits of 404B audits. Research has examined their effect on financial reporting quality and on firms' operational and investment performance. The research documents that SOX 404B audits of controls contribute to reporting quality and investor information in 3 ways. First, through detection of control problems, by providing information about control problems to managers and investors who can act on them, and by reducing incentives for intentional circumvention of controls to misreport or to commit fraud. In the spirit of Nemit's comment this morning about seeing, the most significant failures happening outside of the publicly listed companies, frauds like Theranos and FTX happening outside the public markets because their founders knew they could not survive the scrutiny that they would receive in the public markets. Okay, so as a result, internal control audits have been found to improve financial reporting quality for registrants and to improve operational control. John Coates and Suraj Srinivasan co-authored a study in 2014 with a very extensive overview of the SOX literature. And at that point, I think the take was there's general findings supportive of the 404B audit improving financial reporting quality, but certainly there's nuance. And I would say there's still nuance, but I think that increasingly the evidence has tipped toward highlighting the benefits of 404B audits, that they reduce the likelihood of material misstatements, and that they're associated with more informative financial statements and lower cost of capital. Part of this comes from, in fact, the sequence of exemptions that have taken place, which give researchers an opportunity to take a look at very careful differences. They're very close differences in firms under the treatment of an exemption for the 404B audit versus not. And so the findings, I believe, are the strongest where the research designs are the cleanest. But a number of them, for example, that the Jobs Act exemptions led to greater underpricing of those companies when they went public because investors had less confidence in their financial statements. On M&A transactions where a firm has the option to exempt the acquisition in the first year, investors view that negatively. There is evidence on a number of different fronts. Internal control weaknesses are predictive of future fraud, and so informative. They do play an important role in informing investors. And I think some evidence is really trying to link costs and benefits more directly and in a particular context. One of the comment letters written in the 2020 SEC review, 2019 review of the filer definitions, offered some, cost benefit calculations around investor losses relative to avoided losses, but costs incurred associated with ICFR audits. And the magnitudes that they estimate are substantially in favor of the 404B audits being beneficial. And those are just the shareholder losses. Then there's losses to others beyond the shareholders, employees. In AAER cases, lose half of a year's salary on average. That is all employees of firms with AAER. So very sizable damage beyond just the effect on shareholders. One more significant finding, and that is that the 404A is not the same as 404B. Researchers find that that 404A reporting tends to miss internal control weaknesses. The estimate is on the order of about half, and that the evidence is that when firms transition from exempt status to non-exempt status, there's significant reporting by auditors through 404B of weaknesses that were not previously reported. So they improve on the information that investors have about the control environment within firms. Stock price reactions are pretty typically negative. 1% associated with ineffective controls, and that is very significant in terms of actual valuations relative to costs of audit. So those are just some of the findings, and happy to discuss those further.
Great, thank you, Professor McNichols. That was a great summary of the findings. So you brought up the exemptions and the different costs and benefits around that. So I want to spend a little time talking about that, especially around 404B. So Professor Allen, could you discuss some of those key changes over time, such as the Jobs Act that was mentioned, or maybe the SEC's 2020 rule?
Yeah, so I appreciate that summary by Professor McNichols. I think there's a lot of evidence suggesting that overall internal controls regulation has benefited firms. I think also when we look at this timeline that you have on the handout in front of you, we can see that there's been a targeted effort aimed at sort of fine tuning, I would say, those regulations, because we're always thinking about regulation sort of on a continuum. On the one hand, you can have full risk mitigation, kind of like insurance. You might pay a lot for it, but it precludes bad outcomes on the back end. You might also take a strategy which is more remediation oriented, where we have less upfront costs, but we recognize that in the future we may pay a larger penalty. I think a lot of research, including my own, that's come later in time, has tried to calibrate where are the places where we see the largest benefits or the largest risks associated with financial misreporting or fraud, because the more that we can calibrate the regulation to target kind of high risk, therefore high reward areas, we're going to optimize on that cost benefits continuum. When you look at this timeline here, I think some of the things that are really notable is this AS5 that's mentioned here, kind of 2007. So initially, PCAOB regulations through AS2 were highly prescriptive in terms of kind of check the box prescriptiveness for internal controls audits. So I was at a public company during the time that internal controls were being first rolled out. And to be honest, everybody was getting their feet wet trying to figure it out. I remember having conversations with our auditor at the time, like, can you just tell me what we need to do to meet this standard? And if you'll tell me what to do, we will do it. And if you think about that, there may be some benefits. Maybe there's some uniform set of controls that benefit firms across the board. But I think optimally what we want is a risk assessment for managers to look and say, here are the places where it would really hurt us to have weak internal controls. Here are the biggest risks of fraud or misappropriation of assets or misstatements. And by the same token, what you'd like to have is then auditors who come in and do the same thing and compare their assessment to managers, and through a careful, I won't call it a negotiation, but discussion, arrive at a better place. And then on top of that, we'd like to believe that the PCAOB, when it reviews auditors, would do the same thing. I think baked into the system, certainly pre-AS5, and I would say anecdotally, maybe even post-AS5, there's this idea that an ex post bad outcome can cast skepticism, let's say, on an ex ante good decision. So as a manager, I'm sometimes faced with the dilemma thinking about, if I just follow the check the box and something bad happens, at least I can say, well, I followed the rules. I did it your way. If instead I take a very risk conscientious approach and say, maybe we don't need that control, maybe we need more of this control, and ex post it turns out bad, I'm left a little bit uncovered. And so I think that that's the difficult space that firms and auditors, and honestly the PCAOB finds itself in, is how do we really promote the type of tailored, customized to the unique risk of the firm approach that I think everybody would agree is the most desirable. The other thing that I'd like to highlight, focusing on this timeline here, is when we think about exemptions from Sarbanes-Oxley 404B, they've largely been based on metrics which consider the direct costs of regulation. So if we think about a smaller firm, $1 for a small firm is more relatively costly than $1 at a large firm. A firm that's in its early growth stage, newly emerging on the public market, has a lot of additional costs associated with becoming public that can be sometimes prohibitive to entry or make it very difficult for firms in those early years. So we've tried to provide exemptions. I would say the one thing that I would love to see more research on is a focus on where are the benefits the greatest. I was talking about this with some of my colleagues at lunch. Although it may be, for example, that for emerging growth company, the costs are much higher of compliance. For certain firms, it may also be that the benefits are much higher. Having not been a public company for a long time, they're less likely to have robust systems of internal controls already in place. So having a forcing mechanism to create those conversations may be relevant or important. The other thing that you'll notice in this timeline, though, is, again, this focus on sort of direct costs. It's very difficult to design an exemption that looks at indirect costs. So I have research that shows for a certain firm type, a certain subset, they may have innovative firms that do highly exploratory innovation. This 404B requirement may have some negative consequences. We can't really design an exemption around growth stage. It's a complicated kind of strategic factor. But I do think, and this came out in the hearings that happened in June, there's opportunities for the SEC and the PCAOB collaboratively to look at the data they have and say, what types of firms do we see the greatest risks or the greatest problems happening? What are some common factors that prevail those firms? The SEC's 2020 change here where they included exemptions related to revenue and not just market cap, I would say is an example of that kind of strategic or targeted thinking, where the SEC, and I understand, in conjunction with a white paper that Josh wrote, which was Dr. White, which was informative to this point, said, hey, when we think about the benefits of internal control regulation, turns out that most financial reporting fraud centers around revenue recognition. So maybe we should think about whether the risks are the same for a low revenue company as they are for a high revenue company, even when we control for market cap. So I think that kind of creative thinking to say where is more needed, where is less needed, can help us get to a place that hopefully is less controversial than I think discussions around 404B have typically been in the political sphere.
Great. Thank you, Professor Allen. That was a really helpful way to think about the changes and the costs in both direct and indirect terms. So, Mr. Watanabe, I want to ask you from a company perspective, what challenges do smaller companies face? I understand it's probably unique in the biotech space where many are pre-revenue or low revenue. And so in those cases, do you see indirect costs that aren't captured in the entire amount? And just what is your overall perspective on ICFR?
Sure. So I think first of all, I should say I'm of an age that I lived through a lot of the scandals, right? So I can appreciate why SOX was passed. I can appreciate why ICFR is important, and I absolutely no beef at all with the general principle, right, of enhanced control and reduce fraud. That's not good for anybody. I think if you think about the economy and all of the companies, public and private in the economy, they run the gamut, right? We started out as a 3-person company with $150,000 in the bank. That was where we started, right? We grew when we went public. We had about 50 employees and about a $600 million market cap at IPO. We're now 350 employees and we have a market cap of about $2 billion. I used to work for a large Fortune 500 company that is 20,000 employees, and I think it has something like $700 billion market cap, and that's Eli Lilly and Company, right? So companies exist along this sort of spectrum of size and complexity. And then I think there's also this piece of whether you're pre-revenue or not, which is exacerbated in biotech, but certainly isn't unique to biotech. We've overlaid on top of that a regulatory structure that is not a continuum, right? It's a cliff. You're a 404A or you're a 404B. And there's no in between. It's one or the other. And once you fall off that cliff, there is a fairly significant impact for the company, and I can talk about that in a little bit more. So I think, you know, there are two sort of aspects to this question. Is the cliff in the right place? And I would argue that it's probably not. Or are we measuring the cliff in the right way? And again, I would argue we probably are not. And should it be a cliff or should it be more of a stair step, right? I think, you know, when we were a 404A company, I still had to sign the financial statements, right? I was putting my own personal name and my own personal criminal liability on those statements every time when I signed them. So I took our internal controls very seriously, as did my CFO, who designed the controls and had to sign with me, and who was going to jail with me if we did something wrong, right? The next year, we tripped 404B because of our market cap, even though we hadn't generated a single dollar of sales. We still haven't generated any profits, by the way, in 9 years of existence. And all of a sudden, we had to spend all of this extra money to have other people come in and double check the things that we were doing to make sure that it met the requirements. There are probably situations where that's appropriate. I don't think that a 100-person company with I think we're about $1 billion in market cap because people saw the promise in the company, is probably the right place to throw all of those additional controls on. And the money that I spent to comply with those additional controls was money that I was not spending on developing new drugs. I have a finite amount of money, and if I'm spending millions of dollars extra a year, which is what we were spending to comply with 404B, that's millions of dollars that I'm not spending investing in new drugs. So I think that to Professor Allen's point, I think that, you know, there's an opportunity to continue to refine where these various control levels kick in. And I think that there should be some serious thought given to, should there be an intermediate category, right? My complexity today is nothing like my complexity when I was 3 guys and $150,000. I knew everything that happened. I wrote all the checks at the beginning, right? But I also am not the same as Eli Lilly and Company in terms of risk or complexity, but I'm being held the same standard as Eli Lilly or Pfizer or General Motors. And I don't really think that that is necessarily appropriate or the best use of shareholder money.
Great, thank you for offering that company perspective. I wanted to see, did any of the other panelists want to follow up on any of those points?
And I'd love to jump in right there at the end. So I'm mindful that I'm doubly removed here. I'm an academic and I'm not an accounting academic. So I'm going to ask questions rather than say affirmative things. But I am sort of puzzled at the notion that AS5, which is the current standard that applies to Eli Lilly and to smaller, simpler, earlier stage, possibly no revenue or profit companies, doesn't allow for variation because by its terms it does. And so there must be slippage, and I'm wondering why. Why is it that as you take the words on the paper, which say risk-based, which say variation, okay, which say focus on areas that are the most risky and put more money into controlling those, and don't worry so much about ones that are not as important. Why isn't those words being translated in practice? Now, I heard Professor Allen allude to one possibility, and I think it's an important one the PCAOB needs to be mindful of, which is it may be that the same kinds of agency problems that tempt managers to not do well by shareholders by, say, misreporting might also tempt them to overspend if they think there's some public pressure on them that will be personally felt more so than the shareholders would appreciate. And if that's true, then that's something that somewhere the PCAOB question, how can it address that? All right, so one possibility might be, again, it frames a question, is there information that can be gleaned not by inspecting directly solely, but by listening to or getting information about the colloquy between management and audit firms over how each of them view the differences? So when there are weaknesses, wouldn't it be useful to know whether the audit firm's identification of a weakness is one size fits all. Well, you're not doing what Lilly does, therefore we say you have a weakness. Is that the basis for the identification of the weakness? In which case, maybe the guidance from PCAOB should push back against that and say it's not appropriate for an audit firm to be doing that kind of simple-minded approach. On the other hand, if management is saying, well, I just don't have time to pay attention to, and then they say something that is creating, in fact, a major weakness for financial statement preparation, even zero revenue companies can suffer theft. So if you have a lot of cash and you're burning through it for R&D, but you've got a whole bunch of people in decentralized offices, and we want to encourage decentralized, innovative thinking in certain kinds of companies. But if you give them all the ability to write one check without anybody looking over their shoulder to spend money in what they will defend as useful ways, but actually it's for their cousin who runs another company, that it's actually just a way of deriving rents, that's a real weakness even for a pre-revenue biotech company. And so do the controls, are they mapped onto those kinds of weaknesses? And again, if the current system is not producing good tailoring, then maybe the words need to be changed. Maybe the cliff that you're describing, maybe we need to adjust where the cliff happens or how the cliff is described. But maybe it's also more, there's more attention being given to the way that standard is actually being implemented in practice. Stop there.
Okay. Thank you for that. I think that's a very, very important perspective, thinking about sort of one size fits all in terms of company size and one size fits all in terms of the actual way that ICFR is implemented. Professor McNichols.
I'd be happy to also comment on Professor Allen's point that having that the cost benefits on controls can be nuanced, and really understanding those trade-offs well is critical, and that the SEC and PCAOB in particular may be especially well positioned to carry out those kinds of studies. I think that's an especially important direction. Thinking about the control environment for smaller companies, the data, some of the statistics can be concerning, and I'll just give a few. Audit analytics documents that 25% of all registrants reported an internal control weakness in 2023. This is all publicly listed companies, 25%. Predominantly management 404A reporting as opposed to 404B and large accelerated filers, but nevertheless, that's a very sizable fraction, and we think there's underreporting in the 404As. The most frequently reported control issue was accounting personnel resources at 73% for the management-only reports, 60% for the auditor reports. And so we expect these control issues to persist. So I think that's an important thing to keep in mind. Surveys by the Association of Certified Fraud Examiners and the Center for Audit Quality both highlight predictions from executives and investors on the order of 1% to 3% of revenue in expected fraud. And small non-accelerated filers report internal control weaknesses close to 40% of the time. 25% of publicly listed companies in the bottom two deciles of market cap had an NT or late filing of their 10K or amendments. So, sizable limitations in financial reporting capabilities and the controls in that sector. And so I think the costs are very significant relative to these smaller firms. That may be why these control environments are so weak or so much weaker. But understanding how to sort of design classifications is a critical dimension of this, and evidence regarding those trade-offs, I think, is something that really has to be pursued.
Great, thank you for that. Let me pause here. I see a couple members of the committee have some questions. Sandra, did you want to ask your question?
Yeah, mine is maybe just a little bit of sort of like where we were, then we have ICR, and where we're going, right? So we've all I mean, when I started working at KPMG, I can remember documenting controls and testing controls and drawing flow charts and all that sort of stuff. So we still tested and we made decisions based on internal, what was going to be controls based and what was going to be substantive, right? So we still had that. We didn't give an opinion on internal controls per se, right? And then we had Sarbanes-Oxley, right? And you know, the question to me has always been whether it's 302 and 404A and the shift in resources dedicated to accounting, right? Because I lived that and felt that, and that did happen, right? That there was that personal liability that Mr. Watanabe spoke about, right? But it seems like Maureen is saying, well, even when you go from 404A to 404B, there's still an improvement. But I wonder if that's because actually more resources come from the company, and because of the size of the company, sometimes they switch from smaller audit firms to bigger audit firms, right? So, you know, so we're saying that we move to 404B and it gets better, but the real why it gets better isn't particularly clear for me, and whether the cost associated with 404B and the decrease in weaknesses, if there's an ROE there that's worthwhile, right? That's not particularly clear for me. But I also wonder, as we go forward into a world where we can, you know, used to do controls-based testing so that you could reduce the amount of substantive work that you had to do, right? But with technology being able to do more substantive work, what degree will controls testing actually go down, and what does the future of that look like, right? I mean, because fundamentally, to me, one of the biggest changes, and I moved from being an auditor between AS2 to being a preparer in AS5, right? I saw in both instances a greater focus on resources because of 302 and 404A, right? But obviously it must not be perfect, right? But I think there's a lot of other things. I'm just wondering, have we done enough to isolate what those effects are? Like what's really contributing to that? And I guess, Professor McNichols, you seem like you have studied that a bit more. I'm just curious because I'm trying to decide, is it worth it, right? 404B.
Yeah, so one study on this was conducted by Wiley Gay, Allison Kester, and Sarah McVeigh, published in, I think it was 2017, basically looking at sort of the ability, the differential between 404A and 404B detection. And as I think they attribute a significant part of the difference to the better ability of auditors to detect control problems, and that having them detected and brought to the attention of management causes them to be remediated. They also actually take a look at improved operational performance as a benefit of 404B control weakness remediation, and document significant improved performance. Professor Allen will talk about it in the context of her study, but in their study, they definitely found sizable benefits associated with better investment, better operational control, better performance. And we know this more broadly, that when information within firms gets when financial reporting information is distorted, it actually affects investment decisions and operational decisions within firms. So that's on the benefit side, but in terms of why would we see a difference between the 404A and 404B, their evidence suggests in part it's auditors' ability to detect these errors that management may not have. There may be incentive differences as well.
But management's still liable, right? So you're saying it's really the audit that is changing the behavior of, well, detection, but also behavior of management.
Yes, I think they're saying that the audit, the fact that the control system is audited affects the quality of the reporting on weaknesses.
In the studies, have they looked at the costs that management puts towards internal controls in the differential between a 404 environment and a 404B environment? And is it significant?
They estimate about a 35% increase in audit fees moving from sort of a 404A environment to a 404B environment for their sample, which was jobs, from 2003 to 2014, a sample of firms that moved from, so smaller companies that moved from exempt to non-exempt status. So
Right. I'm trying not, I know the audit fees will go up. What I'm trying to understand is, did the studies isolate how much management spent on internal controls under 404A and as they moved into 404B? So in fact, there was an incremental increase from the company side.
no, I don't think we've gotten that level of granularity. Yeah.
So I can speak from personal experience. There's a pretty significant increase in internal cost in order to meet the demands of the external auditor. I will also say, having run a company that's been 404A and 404B, it had absolutely no impact on how we run the company, right? I'm a shareholder, I'm a fairly large shareholder in my company. I take shareholder value very seriously. A, because I'm a shareholder, and B, because I have to raise money periodically to run my company. And we are constantly looking to run the company the best way possible and to use shareholder money as effectively as possible. This idea that somehow 404B improves my performance as a management team, I don't buy it, quite frankly. These quote unquote weaknesses that these audits turn up, they are in fact comparing what we do to this checklist or this model or what. I'm not an accountant, so I know there's some term that they use, term of art for it, and it's measuring that against whether I've hit the checklist or not. It's not really measuring how well my business is performing. So to equate 404B to better shareholder returns, I think there's an issue of correlation versus causality in my mind there, right? I would defy anyone to prove to me that going from 404A to 404B actually improved the performance of my company. And when you take into account the amount of money that we're spending every year, and it goes up every year, it never gets better on complying with 404B. That's, again, money I'm not investing in other things. Now, again, I'm not saying to dismantle 404B. That absolutely is not my position. My point is that we need to have, I think, more flexibility, more tailoring to the individual circumstances of the companies in question versus having this very binary situation where, I really am interested in your points, Professor Coates, but I'm not sure that's actually how it works, right? That my auditor shows up and they're holding me against this one standard that is the same standard for Eli Lilly, right? Now, it is obviously, it's going to cost them more because they're a much bigger company, right? But it's effectively the same standard I'm being held to. And so maybe there is an issue in implementation rather than regulation. I don't know. But what I experience as a company is really an excessive amount of internal controls that, in my view, are excessive for our company and our risk profile.
So I'm going to start by agreeing with you. I can say it's happened, that I'm not purely an academic. I did serve as a monitor for a large company, a large equivalent of a Lilly, not in pharma, and watched firsthand how the company tried to control itself, and also had a team that were doing things not unlike what auditors do. And I had challenges at time controlling my team because they had checklists and because they were not necessarily the most thoughtful applicants of a standard that they were being asked to put to bear. And so that's where I'm agreeing with you. I found myself at times having to tell the equivalent of an audit team to shut up. They were pushing for things that were just not at all cost justified. All right, so that's where I'm agreeing. On the other hand, there were times when the most obvious things that we were looking for, management resisted. And management resisted not because they thought of themselves as not good shareholder stewards. They just had an agenda. They had a bandwidth problem where fixing real risks to the company, which had produced hundreds of millions of dollars of liability and sent one of the EVPs to prison. So even though you'd think that the threat of criminal liability would have deterred him from making the decisions that he made, he didn't, because he had a whole lot of other things filling up. I think this is ultimately my root cause analysis. He had a whole bunch of other things filling up his mind share, so that the real risk he was creating, and the reason he went to prison is because he put some of the stuff in emails, led ultimately to a conclusion that he had knowingly encouraged his team to commit fraud over a period of years. And it wasn't like major fraud, it wasn't quite Enron fraud, but it added up to enough that, again, he went to prison. So, humans are fallible, I think, is a partial answer to this, Andy. And so you can have, like, all the rational choice models in the world. There's a value in having someone else ask the question, are you sure about? And so there's some value to checklists, actually, as long as people understand them, that they're checklists. They're not rigid model. A model, I would resist model, because actually I don't think there would be a single model that would be appropriate here. And so the last thing I'd say is, if there are lots of entrepreneurs or managers who were reporting, my audit team in 404B work has used a rigid approach and has told me I have to do the following because Lily does it, that's something PCAOB can fix, I think. I think you have the tools to fix that. So I'll stop.
Can I just add, but that's the point I'm trying to get at. Like, this is all about behavior, right? It's all about incentives and behavior, right? And what is sufficient, right? And what you're saying is 404A isn't sufficient, right? Because the person has a mind map and they have a lot of other things on their plate, and nobody's going to ask them until they really ask them, right? And so they're willing to make that trade, right? And so that's what I'm trying to discern. And if 404B were to go away in an environment where things can be more tested on a substantive basis, would that change? Or, if 404B, the requirement went away, auditors would still be taking a decision based on a risk-based audit and what's control-based and what's substantively based, and how much would we regress is what I'm trying to discern, right? Because there's so many things going on there that how do you parse and say one thing, what's the most useful thing?
So one of the things I just wanted to add to the conversation is that in this calculus, this internal calculus that a manager is doing, they're going to be weighing firm-specific costs and benefits. I think one of the important roles of regulation is to account for externalities that are felt outside of the firm. And so if we think about, the genesis of this regulation in the first place, it wasn't just that we had specific firm failures, but it was the systemic costs that were borne by capital markets as a whole as a result of those failures. And so I think it's really important when we're saying, is it worth it at the firm level, that in that risk category is not just risk to the firm, but risk to the system of having poor internal control environments. I think it's an interesting thought exercise that you're posing, essentially this duplicity of control oversight that happens as a consequence of the audit, which takes into account controls. But in essence, that works itself out in terms of if controls are low, we put extra effort into the audit. If controls are high, so there's controls that can, potentially mitigate one piece of it. But I think more broadly for the firm, the reason that internal controls audits matter is in some ways the same reason that audits of financial statements matter. We could say that managers should have incentives to report truthfully, to produce financial reports that are whole and complete. They bear personal liability, and yet we see a role for auditors to come in and double check whether it's for intentional or unintentional errors, that second set of eyes. I think quantifying it is a challenge. So, to add to the research that's been cited, I think there's a clever recent paper that tries to look at or to quantify the costs of regulation for public firms by using what's called like a discontinuity design. So we look at bunching to say, do firms strategically stay below the market cap that would trigger 404B implementation guidelines? And in fact, they do. And so they use this model to try and quantify what are the costs. But again, I think the caveat to that study is they're talking about firm-specific costs, right? They behave as if it's net costly for them without thinking about potentially benefits to the system of risk mitigation. And so again, I would go back to this idea of insurance and say the task of the PCAOB or SEC or whoever is making decisions in this space is to think about how much risk are we willing to bear in the system to prevent costs, because I think there are certainly costs associated with compliance. And firms would say those costs for us specifically are not worth the benefit. I think a lot of firms would say that. But the question is, are those costs today worth the mitigation of sort of future consequences, or are they too high? And if they're too high, without jettisoning the whole system, can we find ways to be more flexible and nimble and adaptive in the way that internal controls regulation is actually implemented at the firm level that will bring down the costs without increasing the risk of future poor outcomes?
Thank you. Nimit, I think you were next on the question.
Thank you. So I just wanted to weigh in on this. So I'm very sympathetic to this point that you're making, Mr. Watanabe, about you have $1 million and you, by spending it on compliance, you're not spending it on drug development, right? Which clearly is what the company is about. But we are, like as Professor Coates said, we are talking about a disclosure rule, right, with respect to internal controls. So I'm hoping you can walk me through the decision-making process that you would have gone through. What if you spent less on compliance, where you accepted having an internal control weakness, you accepted hiring a smaller auditor that might not be as reputable as a Big Four auditor, and provided those disclosures to your investors, telling them, I mean, you have conversations with people in the investor community, so you told them that, look, this compliance cost is right now not worth the benefit. What would the reaction be like? I mean, this is perhaps a very naive question, but what's wrong with having that discussion? Because when you make a valid point, right, that if you spend this money on compliance, you're not spending it on drug development, and without that, the company is not going to have a future. So,
it's an interesting question. I really honestly couldn't tell you what my investors would think. I'm not sure I would want to run that experiment either. But I mean, I think, it comes back to, having gone again from a private company, taking the company through IPO, being 404A and then becoming 404B, as we prepared to become public, and then went through the IPO process, we built a system of controls that we thought were appropriate for where we were as a company in our evolution, given the complexity of our business and so on and so forth. And by the way, we continue to refine those controls based on our own internal management judgments. I met with my audit committee this past week about our signature policy, right? That wasn't driven by the auditors or by anything else. It was determination that we needed to make some adjustments in our signature policy just as a good course of business, right? So we're constantly fine-tuning it. When we went to 404B, we discovered that our auditors had a bunch of demands on us around documentation, and then there was just the process as well of satisfying them, all of the testing and so on and so forth. And they were requiring things, and I'm not an accountant, so I don't know why, Professor Coates. Maybe they were following a checklist, but there were a lot of demands that were made on us that we really didn't necessarily think were needed, right? But they were required because I couldn't afford to not get that attestation from my auditor. So we ended up adding what we felt were excessive controls for where we were as a company. Now, they may not have been excessive, if I was 10 times bigger or 20 times bigger, right? But at that point in time, in that point in my company's evolution, we didn't feel they were necessary, because if I had, I would have put them in place myself, right? But we were forced to comply and spend that money to increase it. I think I strongly suspect if my auditors came out and with some statement that I had a bunch of material weaknesses, whether they were really substantive to the business or not, it would be very bad for my stock price. So I don't want to run that experiment, right? And that's part of the problem, is that is that we were required to have this attestation from our auditors, and you know, it's either you live or you die by it, and versus, you know, what I think in the absence of that, or if there was some intermediate step maybe in the stair stepping up of regulation, you know, my auditors may come in and have a conversation with me. That's a very different thing than them issuing an opinion that I have a material weakness in my company.
I mean, so just to follow up on what you said, if I understood correctly, I mean, if you had material weaknesses, your stock price, you think your stock price would have fallen, right? And the confidence that not having a material weakness provides to investors is the benefit you're seeking. And I mean, the cost that you're spending for it with respect to the auditors, I mean, it seems like you thought that was worth it for the benefit, right, of not having a material weakness. But if you were in a position where investors primarily cared about the data point from your next trial, then things that I don't know if you would have worried as much about having a material weakness, right? I mean, is that fair to say?
I'm not sure I entirely understand your question, but I will say, I think, you know, for our investors, on the auditing side and Sarbanes-Oxley side, there's only downside risk, right? My stock price doesn't go up when I clear my audit and I get my attestation. It would go down if my auditors came out and said, these guys do not know what they're doing, right? We have a real problem. But you know, the reason that people invest in our company is because they think that what we're doing is going to create shareholder value in the long term through, you know, approval of our products, development of new products, approval of our products, and selling of those products, right? That's where the upside is. The downside's, it's all downside for me from an accounting standpoint.
I'll push back on this once a little bit and then I'll stop. But the reason why there is no downside, the reason why the reason why there's no upside is because there is a base level of regulation, right, that sort of sets the floor in terms of investors expect things to be okay if you're raising capital in US markets. If you did the same thing in a foreign market, you wouldn't get the same cost of capital. You wouldn't be able to raise money on the same terms, but you're able to do that. And that's one of the privileges of raising money here, right? So I would say that's
there's no question about that, right? But again, you know, I had to go through an extensive, rigorous process to become a public company, right? And it's not like under 404A, I'm off the hook and I can do whatever the hell I please, right? I'm glad to hear this gentleman is in jail. That's where he belongs, right? We have a stick in place when management does things wrong, right? We can't manage out all of that risk. Never will we manage out all the risk in the system. And there are consequences for folks who are either negligent or just malfeasant, right? So, you know, the U.S. capital markets and the general confidence in U.S. capital markets, it's absolutely very important. There's a reason why I'm listed in New York and not in London. But, you know, again, when I flipped from 404A to 404B, I didn't see a bump in my stock price. That's just the reality. Because as a publicly listed company, there's already a certain expectation, right? And again, I'm not suggesting for a minute that we should do away with 404B or we should do away with Sarbanes-Oxley. What I'm suggesting is that we probably need to be a little bit better at tailoring the level of controls depending on the risk and the complexity of the company. And I think our current system is a little too blunt. That's how I would put it.
All right, so we have about 1 minute left, and I see 5 questions on the table. So I appreciate the interest. We may have to continue some of this over the break, but in this last minute, if each of the panelists in 1 sentence could offer a suggestion for tailoring the policy, what would it be?
So I believe that, as Professor Allen suggested as well, a very careful, detailed study of any potential classification revision with a broad array of measures of costs and benefits would be critical. But then to implement it, I would strongly recommend a pilot study to really be able to come up with evidence that really informs us at a causal level.
So I've alluded to it, but I think part of the inspection process should be augmented to take into account comments from management in some way, so that if you see patterns like every biotech company's CEO says we're being asked to do things that make no sense for us, then that can be part of the feedback. Now, I don't have a next step because I'm not sufficiently in the weeds of your authorities of what you could do with that. But I think simply asking those questions would already begin to affect behavior at the audit firm.
I'll agree with his suggestion. I think that makes sense.
I think that's an accurate summary of how I feel. More data-driven approach, more conversations to find out where the risks and benefits are offsetting would be important. And work with academics. We all would love to help with this.
Thank you. As the acting chief economist, evidence-based policy sounds perfect to me. So thank you. I want to thank the panelists and thank everyone for the questions in the room and appreciate your time and your thoughts on everything.
Thank you, Josh, and thank you to our esteemed panelists for this very insightful discussion. We'll now move on to our next session, which is the IAG's presentation on critical audit matters. Jeff Mahoney, our IAG member, is going to lead this discussion. Jeff, I'll turn it over to you. Thank you.
Thank you. Good afternoon, everyone. Let me start with just a little bit of background before I get into our results. Since 2023, the IAG has been exploring and commenting on the implementation of AS 3101. That's entitled The Auditor's Report on an Audit of Financial Statements when the auditor expresses an unqualified opinion. Those discussions have included conversations about what changes to AS 3101 might be necessary for critical audit matter disclosures to meet investor expectations. That work stream included an IAG approved memorandum that was prepared by Sandra Peters that was discussed at the October 2023 meeting. And that memorandum presented 7 recommendations to the PCAOB board on critical audit matters. One of those recommendations, the last recommendation, was entitled IAG Annual Evaluation of CAMs. That recommendation in part stated that on an annual basis, the IAG should publicly solicit nominees for best CAMs and identify 3 CAMs from those nominated that IAG members believe are particularly insightful or useful to investors. Those 3 CAMs would then be featured in an annual IAG public report, which would include an explanation as to why those 3 audit matters were viewed by IAG members to be decision useful to investors and how they might be further improved. So the objective of the IAG annual evaluation of CAMs was to encourage auditors to continually improve the quality of information communicated to investors in the audit opinion of public companies. The project was officially launched at the April 2024 IAG meeting. The PCAOB's Office of Investor Advocate issued an alert requesting the public submission of examples of critical or key audit matters provided in the 2023 audit reports of SEC registrants filing either Form 10-Ks or 20-Fs. The IAG received submissions from 7 individuals or organizations referencing 26 individual key or critical audit matters that the nominators believe provided decision useful information to investors. The IAG members then reviewed and voted on the 26 nominations, and the 3 audit matters that received the most votes from IAG members were identified and discussed at the September 2024 IAG meeting. And then in December of 2024, the IAG approved and issued a public final report entitled The First Annual Investor Advisory Group Most Decision Useful Critical Key Audit Matters for 2023. So importantly, that final report, as I mentioned earlier, included a discussion of how the 3 audit matters with the most votes could be further improved to benefit investors. So the IAG announced its 2nd annual critical or key audit matter evaluation at the April meeting earlier this year. And we solicited nominations like we did the prior year from the public on those audit matters included in the 2024 audit reports of SEC registrants that filed either 10Ks or 20Fs. In response to that solicitation, we received nominations of 20 individual key or critical audit matters. A little bit of detail about the 20 audit matters nominated. 11 were critical audit matters, 9 were key audit matters, and all 9 of those key audit matters were from the audit reports of 20F filers based in the UK or UK companies. A further breakdown of the nominations this year reveals that nominations were submitted by 7 individuals from the audit reports of 11 different SEC registrants. All 20 of the audit matters nominated were from the audit reports of the 4 largest accounting firms, 7 from PwC, 6 from Deloitte, 6 from KPMG, and 1 from EY. Members of the IAG met via Zoom on August 20th to discuss and vote on the 3 audit matters of those nominated that they believed provided the most decision-useful information to investors. The 3 audit matters receiving the highest votes from IAG members at that meeting are first, the critical audit matter in the audit report of Boeing entitled Cost Estimates for Fixed Price Development Contracts. The second was the key audit matter in the audit report of Rolls-Royce Holdings PLC, titled Long-Term Contract Accounting and Associated Provisions Group. And the third was, again, a key audit matter in the audit report of Compass Group PLC, entitled Uncertain Direct Provisions Group. The Boeing critical audit matter, as well as Boeing's other 2 critical audit matters, were nominated by a prominent financial analyst and accounting expert for a large active asset manager who chose to remain anonymous. Anonymous, however, sent me an email to read at today's meeting discussing the basis for his nomination. So let me read his email. Quote, "This is a good CAM because it deals with an accounting issue where significant and complex judgments were applied by management in the accounting, and the disclosure places a spotlight on an issue that is material to investors. Further, the auditor follows up on this issue with a good amount of specificity about the nature of the issue and the audit procedures they undertook to understand and assess this exposure. As a result, these not being boilerplate disclosures, financial statement users were able to come to have a more nuanced understanding of a material issue for the company. And we have a better appreciation and understanding of how the auditor has gone about navigating this exposure in a thoughtful and thorough manner," unquote. The email also indicates that Boeing's auditor, Deloitte, gained additional credibility with investors by providing similar levels of detail on Boeing's other 2 critical audit matter disclosures, which he also nominated for consideration. And the email concludes by stating that Boeing's 3 critical audit matters, quote, "give investors a better understanding of what the audit fees they are paying as the owners of the company are buying," unquote. The second nominated audit matter receiving the most votes was from IAG members was the Rolls-Royce Holdings PLC key audit matter titled Long-Term Contract Accounting and Associated Provisions Group. That audit matter was nominated by Elizabeth Mooney. She's an investor, a board trustee, and longtime former partner of Capital Strategy Research of the Capital Group companies, a very large global asset manager. Elizabeth is currently on a plane and sends her regrets for not being here in person to discuss her nomination. However, she also emailed me the following statement to read at this meeting. That statement says, quote, "Thank you and the IAG members for staying on top of and bringing light to CAMs. Unfortunately, I will be on a flight at the time of this topic. Will be discussed at the meeting, so please share my comments below with the group. PwC's UK's key audit matter for Rolls-Royce regarding long-term contract accounting and associated provisions is decision useful to investors as it is relatively specific about the management estimates which required auditor judgment. Knowing which judgments and assessments were challenged by the auditors is helpful for modeling earnings, cash flow, and valuation, and for conducting scenario analysis. This CAM also alludes to what the auditors found in the last sentence of the CAM as follows. It states, we concur that management's estimates for long-term contract accounting and associated provisions are materially appropriate in the context of the financial statements taken as a whole. She says, understanding what the auditors found is of great interest to investors, since investors use the auditor's report to see the financial statements through the eyes of the auditor. This comment could have been revised to be even more decision useful to investors by specifying, for example, whether management's estimates for long-term contract accounting were at the low end or the high end of the auditor's acceptable range for important line items such as revenues and provisioning, unquote. The third highest vote getter was the uncertain direct tax provisions group key audit matter of Compass Group PLC. That audit matter was not nominated by Anonymous or by anyone on a plane, but by Jared Goodman. He's Senior Equity Portfolio Manager of the Colorado Public Employees Retirement Association, who joins us on the call today. Welcome, Jared. Thanks for your nominations, and thank you for taking the time to speak with us today.
Thank you, Jeff, the IAG, and PCAOB for giving me the opportunity to talk about the progress of CAMs. So much of regulatory the process is punishing the bad actors. I think it's wonderful the IAG is spending the time to recognize the good actors.
So, Jared, first question. Can you explain to us why you believe the key audit matters provided by KPMG in the audit report of Compass Group PLC provides decision useful information to investors?
At a high level, the CAMs that KPMG provided are telling other investors a story versus many CAMs seem to be just fulfilling the minimum regulatory requirement. There's a vast difference in quality. These CAMs are helping me to understand the audit process, how difficult the audit process is, how they dealt with those difficulties. The CAMs are engaging, they use numbers, they detail the audit steps versus many CAMs just use legalese and hedging language. There are 4 CAMs compared to many reports only have 1 or 2. So the breadth is great. They talk about numbers. They have a very close peer, won't name, but they only have 1 CAM. And amazingly, they don't use 1 number throughout the whole CAM. The type of CAM, some CAMs are out there that people won't read. And it feels like some auditors don't want them to read these auditor reports. KPMG's CAMs, are talking to the client, which is the investor, ultimately the investors, versus other CAMs appear to be, serving the needs of management. Which is a fundamental concern among investors about the auditing industry, who they're really reporting to. KPMG's CAMs really are talking to the investors, helping us walk through the process. In general, investors don't know a ton about auditing. You're reading through these CAMs, we understand more and we gain more confidence in the financial statements.
So, Jared, a follow-up question. Do you have any views as to how the information contained in the uncertain direct tax provisions audit matter, which won the most votes of those you nominated, how could that be further improved to provide more useful information to investors? Any thoughts?
Well, first off, I love this topic because tax, investors and myself are not tax experts. So it's an important topic. It's, for auditors, it's very complex, I'm sure. You're dealing with as they point out, you're dealing with various tax entities, state, local, and federal. So it's a complex issue, and they do a really good job of identifying that, helping investors understand the complexity and the challenge of being an auditor, because these are the same issues as investors. It's very difficult to forecast and understand the complexity of auditing. So that's really great about this one, Cam. As far as how to improve it, similar to Elizabeth's comments on roles, it'd be nice to have a greater view of more of an opinion. There's, in this Cam, they say everything's fine, but what level of confidence, what were you concerned about? So there could be more detail. While overall, I think it's a great Cam, there could be more of their voice heard in the write-up.
So, Jared, the objective of this project is to encourage auditors to continue to improve the CAM disclosures so that they're more useful to investors. So what advice would you give U.S. auditors and members of audit committees of U.S. SEC registrants on how they might improve the decision usefulness of critical audit matters in their 2025 audit reports?
Well, to start, I would do what we're doing here today, and it's to look at the good actors, look at the Boeing CAM, or just in general, as you mentioned, this broad UK auditor reports and their KCAMs. I would recommend them to speak to investors to understand what value are they getting from these reports, how could they be better. Treat these as you're selling the value of your service, to your ultimate customers. Most CAMs would be awful marketing materials. I believe that auditors are a very critical part of the capital markets. Show it, brag a little bit about what you're doing. Boilerplate CAMs, KCAMs, only reinforce the false negative that auditors aren't providing much value to investors and just rubber stamping management's numbers. Audit reports and CAMs need to help investors understand what's happening at the audits. What are the most challenging aspects? What are the biggest risks? What are you doing to address these complex issues? How did you address this complexity? Where are you spending your time? What do you think is most material? And then one aspect of the audit report and the CAMs is the potential for a feedback loop. For so long, it's been a one-way street from management to auditors to investors, where I think with audit reports and CAMs, we have an opportunity to start a better discussion. Talk to investors. What are you finding? What are you finding most useful from these CAMs? How can they be improved? An example I would give would be goodwill, which is one of the most common CAMs you see out there. However, it's typically not a very material issue for equity and bond investors. For equity investors, it's a sunk cost. For bond investors, there's no collateral there. Alternatively, revenue recognition is an issue that's incredibly important to investors, is very complex to audit and report, but as a CAM, you see less common than goodwill. So I see this as a great opportunity to start a conversation between our auditors, audit committees, investors, to improve the overall process and disclosure around auditing, which is such an important part of the capital markets.
Thank you, Jared. I'd now like to invite any IAG members, including those who may have voted for the three finalists, to share their views on why you believe one or more of those audit matters provides decision useful information to investors. Just want any thoughts you may have on how those audit matter disclosures might be further improved going forward, or any other thoughts you have on this project or today's discussion. Mary.
Thank you. I think this is a great discussion. I've been involved in almost all of them through the history of this. My concern is Elizabeth Mooney is at a very high level, or was at Capital, in a very specific role. How do we get investors in general to tune into this? I mean, how do we get critical audit matters reported on FactSet and Bloomberg? I mean, I think then we'll see investors more interested in this and in the audit, because looking at Boeing and their long-term contracts, investors are very interested in that. And I think if there's a critical audit matter around it and it's on the major news sources, I think we'll have far more luck in getting more investors engaged in the audit in general. So I think they're a really good segue into getting more general investors, not the specialists involved.
Thanks, Mary, and thanks, Jeff. I wanted to thank you for conducting this process again for the IAG this year. You and your team went and always do go above and beyond in terms of your contribution to our committee. So thanks for all that you have done for this. I do also support what Mary said in the importance of this process. I think the way we get investors interested in this is to make them more differentiated and value add. And we're not like looking for problems. We're not looking for the auditors to say, you know, to give us information that isn't differentiated or, you know, of interest to investors. But I think the boilerplate nature of what we've seen generally, especially in the US market, isn't value add on the most in general. And as such, analysts, myself included, may not pay that much attention to it. It's not value add. And so to the extent we can reward like this great process, that good behavior, and I think it will really help to also differentiate the value add of the audit and the robustness of, you know, the controls over financial reporting and et cetera. So, I mean, I don't have the, it's early on, I think also with these, so I think they're great, and I really appreciate the approach that we're taking here to highlight the positive. I think it's really beneficial, and thanks to those who nominated the firm's CAMs.
Any other comments, questions, thoughts? With that, I want to thank Jared, Elizabeth, Anonymous, and the other 4 individuals who submitted their nominations this year. And I want to thank my fellow IAG members for their careful review and analysis of the nominations received this year. Just an update, the IAG plans to develop and vote on the issuance of a final report as we did last year. We hope to issue that before year end. That will provide more details about the 20 key or critical audit matters that were nominated, why they were nominated, and then discuss the 3 audit matters receiving the highest votes, what was the basis for those votes, and then a section again, like we did last year, about how might these 3 winning audit matters be even further improved to provide better information to investors. So look out for that. It should be issued before the end of the year, but we do go through a regular process, get input from all the IAG members, and have to get a vote on that before it's issued, but our plan is before year end. So I want to thank you all for your time and attention, and I'm going to turn the program back to the co-chair.
Thank you, Jeff, and thank you again for leading this project. Thank you to all the nominators as well as members of the IAG on voting this project. Since we're running ahead of the schedule, we'll take a quick impromptu break and reconvene sharply at 2:20 for our next session. Thank you. We have a minute. If we could get everyone seated, that would be great. Thank you. Well, welcome back. If we could begin. May I have your attention, please? Thank you. So we'll now move on to our next topic on the agenda, which is DRI's Division of Registration and Inspections update on foreign inspections. My colleagues, Christine Gunia, the Director of DRI, as well as Julie Ravis, is going to present. With that, I will turn it over to Christine. Thank you.
Yes, thank you, Saba, and good afternoon, everyone. Julie and I do appreciate the opportunity to join you this afternoon, so thanks for sharing your time. And we're looking forward to discussing with you key aspects of our non-US inspections. Throughout the course of our remarks, we will point out some differences between our US and our non-US inspections. However, we will also discuss many similarities, as not only are the US standards and rules applicable to those non-US auditors, but our inspection approach, our processes, and our objective is the same, regardless of the location of those auditors and those firms. In the time we have together this afternoon, however, we won't be able to go in deeply into any of the topics, but we absolutely welcome outreach at any time, questions as well, because we do value opportunities like this to talk about our work and to take your questions and thoughts. We have allocated time at the end for questions, but like I said, we're also happy to take them as we proceed. Before I go any further, I need to remind you that the views Julie and I expressed today are our own. They are provided in our official capacities here at the PCAOB. They don't represent the views of the board as a whole, any individual board member or member of the staff. So inspecting globally, borrowing from some words of Acting Chair Bodick spoken this morning, inspecting globally is a vitally important component of our oversight activity. I think it's very simply stated that in a global economy, the work of protecting investors does not stop at US borders. No matter where a company is headquartered, if its securities are traded on the US capital markets, or if it otherwise has reporting obligations with the SEC, it must follow the US laws that protect investors. And this includes a requirement that the financial statements of those companies be audited by an accounting firm registered with the PCAOB. And then additionally, I'll point out, and this may come up later in our comments, PCAOB rules do require that an accounting firm that plays a substantial role in the preparation or furnishing of an audit report with respect to those companies, those must also be registered with the PCAOB. So it's those substantial only role, so to speak, firms that also need to be registered. So in our division, we have, and are very grateful to have, a dedicated and talented team of resources that do focus on registration applications, withdrawals, all of the registered firm filings and activities for firms all around the globe. And then similarly, we have a dedicated group of talented inspectors who travel around the world, performing inspections of those PCAOB registered firms. We'll get into some of those processes next, but I just want to mention very briefly, and we'll come back to this later in the presentation, that international cooperation is very critical in our work. It strengthens audit quality globally, and it also facilitates our ability to accomplish the PCAOB's mission. So let's dive into some numbers on the next slide, just to kind of give you a snapshot of the landscape. And this is at the end of or during 2024. So looking back to 2024, because in the next couple slides, our 2025 activities for inspections are well underway. But at the end of 2024, there were approximately 1,600 registered firms with the PCAOB, of which about half or more than half, 850, were located outside of the United States in more than 50 jurisdictions. And I just want to note that these figures do include, these are registered firms, not necessarily all requiring registration and or not, of course, then requiring inspection activities, but they are all as of the end of last year. This was the total population registered with us. From an inspections perspective, during 2024, we inspected, says approximately 232, that's a little bit more than approximate, firms around the world. And in the course of those inspections, we reviewed approximately 900 or portions, I should say, of approximately 900 audits of public companies and brokers and dealers. And I want to emphasize or come back to that word portions, because we do not look at the full audit. We do look at select areas. Oftentimes they're the riskiest areas, but it is portions of those 900 audits. And right now, as we speak, the 2025 inspections are well underway, and our inspectors are busy performing their work all around the globe. Slide 5, just continuing with some numbers, and we debated about A, where to put this, and B, whether you could even read it, so we apologize for that, but let me explain. This is just a little bit more of a presentation of some data from our 2024 inspections. And the footnotes are difficult to read unless you have, even if you have the printout, I recognize they're difficult, but they basically say this. The numbers that are presented, unless the reports have been issued, so for a number of the non-US firms, the triennially inspected firms, there are still estimates in there because we still have some reports to be issued. So some of those numbers are subject to change, and that's basically what the footnote will describe, amongst other things. And I just want to point out, there's a little bit of apples and oranges on this slide. You've got firms being the largest individual firms, the 6th largest in what we refer to as our global network firm inspection program. And you can see the rates of Part 1A audit deficiencies, those being the most significant findings resulting from our inspections. But as you move from left to right on the slide, that's where we have groupings of firms. We have our non-US firms falling in the second to last category and the third to last. Those are the non-US GNF firms, and then the non-US NAF or non-affiliate, global network firm and non-affiliate firms. I apologize for all of the acronyms, but that's where the non-US firms that we'll mostly be talking about today, but just want to give you this snapshot. And also just backing up, you can see year over year in comparison, there is good news. The Part 1A deficiency rates were down in 2024 compared to 2023 in all categories, as well as in the overall results for the year, again, based on the estimate to date. And as Acting Chair Bodick said this morning, preliminary results for the U.S. GNF 6, the U.S. largest firms, are showing a continued favorable trend. But I want to come back to the non-U.S. firms, which is the topic of discussion today. Particularly and unfortunately, Among other firms, the non-US, non-affiliate firms, and we'll talk a little bit more about the nature of those firms later, those as shown in the bar chart continue to have very high deficiency rates. I do want to point out a couple things with respect to these results. Given the frequency for which or when we inspect these firms, year over year, they won't necessarily be the same firms in those groupings. So 23 and 24, even just for that category of firms, is apples to oranges. And in each of these years, there could be a varying number of firms that are inspected for the first time. And our experience has shown that firms inspected for the first time generally have higher rates of deficiencies. Yes. Oh, I'm sorry. I'll pause, Sandy, for a question. Thank you, Julie.
Yeah, my question in slides 4, 5, and 6, when I look at this, I look at all these individual stats individually, obviously, and my challenge is it's very hard, even for me who looks at these things, to really conceptualize them in a way that illustrates where are the riskiest areas of the globe, right? So is there any information or visualization, like of the 1,600 registered firms, so 850 are outside the US and 50 jurisdictions. Sorry, I've got a breeze over here. Where are those, right? Because that's sort of an interesting question for investors, particularly when we think of the fact that the SEC is doing a proposal on foreign private issuers, right? And then the inspections in the 900 companies, and then we say non-US NAF firms with these high deficiency rates. It'd be nice to know what country those are in.
Yeah.
Right. So at the beginning of the meeting, you weren't here. I said, one of the things that we as investors need to do to actually help the PCAOB is to show how relevant and important this is. Because as a former member of the PIOB, right, I really believe that the PCAOB has helped audit quality globally, right? And because some of the people who were most interested on the Republican side in retaining the PCAOB, it was about the Holding Foreign Companies Accountable Act, right? But I need data to help them and others see that. And so I'm just wondering, or maybe I'm putting out a request that there is a way to visualize this in a way that's saleable, marketable, and meaningfully helpful for the PCAOB in talking with others.
Yeah, I'll start, Julie, just very briefly to thank you for your question and for your support, your comments there. We hear that often, and we have over the course of the last couple years at least made improvements to our website where you can, and I know you said visualize, but you can sort and filter and compare and contrast. And then we're also building charts, and we have built charts on our website where you can make some comparisons. I don't know where we stand yet with our world map where you can kind of click on.
That's what I want.
Is that coming?
So there is actually a world map. It's under, and I don't have my computer, so I can't show it to you. However, if you go to the international website or the international landing page of our website, our colleagues in the Office of International Affairs have actually worked tirelessly to create that world map, if you will. And it presents to you, obviously, the world, but also the various countries for which there are registered audit firms, the market cap of those firms, and which ones we've inspected and not inspected. So when you look there, you'll get that sort of snapshot of where the issuers are. And
not
where the firms are.
Overlay of their inspection.
The overlay of the inspections comes from the inspection report section. Now, the that overlay that you're looking for is something that they have been, our Office of International Affairs has been working with to try to get that second overlay. And so right now it's in two different spots, but collectively you can download the information from the inspection side And the other piece is right there, and you can kind of see where that's at, so.
Yeah.
But we do
Yeah.
continue to work on initiatives to improve the data and how it's depicted and analyzed and grouped and whatnot on the website. So we're
Right.
continuously,
Because those,
we appreciate that
because those
feedback.
firms, and then you could look at those firms and their market cap, and it gives you
And the
you know,
geography.
much greater context in a language that investors understand, right?
And sometimes we also try to make those comparisons through some of our spotlights or
Yes.
audit focus or something like that to try to dive down to the places where we may not have the information readily available on the website, but where we think it could be important for the stakeholders to know. But I appreciate, as Christine mentioned, it's not all in one place, but there's different pieces,
Yeah.
and we try to make that available.
Thank you.
Of course. No, thank you for the
Some more
question.
questions.
Yes.
Two questions actually. So one is can you give us a sense for what are, or maybe you will come to this, but what are the reasons for these deficiencies, and have they changed from 23 to 24? That is one. The other is, do you have data, do you collect data on how many downloads there are of these reports, just to see what is the consumption of these reports? Are people looking at them?
Yeah, I'll take the first question. And we appreciate this, and we knew we would want to maybe go a little bit deeper, so happy to go in the depth that you want. We don't have data presented for the areas, but generally speaking, across all firms, auditing internal controls over financial reporting, auditing estimates, to some degree auditing revenue and inventory, which are generally the higher risk areas anyway, and or pervasive, right? Internal controls over financial reporting. So the areas are generally consistent year over year, but again, depending on the firm or the location, there could be some ups and downs. I don't know if there are other areas I'm missing, Julie.
Yeah, I think the other thing to keep in mind too is that on the non-US inspections, we do inspect a lot of first-time firms. And when we do that, we do find that that's an education experience for them. I think especially on the non-US side, there's a lot of dialogue and it is very much appreciated, but sometimes because those firms don't always have sort of the resources that a global network will have, then they might not have those individual guidance and methodology and the like, so that sometimes also causes some of those deficiencies to occur. We do see then when we go back for another inspection, we see improvements in those. But it depends on the resources they have available, how many they do. Some firms just do one, and when they do just one inspect or one issuer, then that's hard to have a robust system, if you will. So that's part of what we see. I was going to save this for later, but maybe I'll mention it now, is that earlier in the beginning today, there was someone that mentioned, one of the IAG mentioned that, we need to help some of the smaller firms. And we recognize that, and especially from the international side, where they may not be able to attend a small business forum that we have available or participate real time on one of the quality control websites that we're going on. So our Office of International Affairs, in cooperation with some of the other divisions, has gone ahead and we recorded videos that are posted on the international website for those firms that talk about the PCAOB activities. First, from an overview perspective, second, from the inspections approach, if you will, when you get inspected, especially those for the first time. We also, there's one on enforcement, and we have been working on, and soon to be posted, some other aspects of, especially from an inspections perspective, that could actually help those firms. When we're in the field, and I just came from an inspection recently, we also have dialogue with some of the leaders of the firm to ask them also what are things that we could be doing, because we don't have the same opportunities to interact as we might on the domestic side. So we asked them, what could help you? What might we consider? What can we take back? And we think about that as we consider additional outreach opportunities.
And this to the second part of your question, I don't want to forget it. Inspections, we don't have the data. I imagine it exists with OCE about how many clicks and users on the website. So maybe we can take that away. Thank you.
Thanks for this. A couple of questions just about the comparative advantage of the PCAOB here. Do any other regulators in the US have concurrent or overlapping access to this information? Like the information that you get in the inspections, or is it only the PCAOB that has access to this type of thing?
So, you want to talk about where our inspection reports are shared?
Yeah.
Well, when we issue inspection reports, we do share them with certain regulators, i.e. state regulators. The SEC gets a copy as well. So,
but they don't independently have authority to get that information. It has to run through you first.
I believe so, yeah.
And then,
unless the firms are willing or able to share, of course.
So the PCAOB is like uniquely situated in that sense to be at least the first line of defense to getting this information. Interesting. And then the second is there any reciprocal obligation we have on the other end, or the information is a one-way street? It only comes to us?
No.
Like reciprocal information sharing obligation that we have for for the issuers here?
So information, information that we collect in the course of an inspection, of course, is protected under 105(b)(5). So we have to be very careful about the information that we're collecting. And for the non-US side, we enter into, with certain regulators, statements of protocol. And in those are confidential sharing agreements that are actually led by our Office of International Affairs in collaboration with other offices and divisions. And they look at the specific rules and frameworks and legal aspects of individual countries. If we're able to enter into a confidential sharing arrangement, then we will share with the respective regulator, but then also the respective regulator is sharing with us. That's usually done on a firm by firm basis. And so we look at that from that perspective. Sometimes we're in the field together. We'll talk a little bit about that, but that's the means in which we're able to share. And then outside of that, we do participate in several IFER working group and task forces where regulators come together and have opportunities to share concerns, good practices, things that work, things that don't, themes, etc. So there's also a confidential process of that too, and we don't speak specifically about any particular firm, but it does help us to share our experiences on what is happening, where there might be risks, where there might be good practices happening, where the firms or the auditors might need just some additional help. And that's a regular part of our interaction with non-US regulators and also with some of the global networks or the firms that participate in the forum of firms. Again, it's a matter of collecting information so that around the world we can all advance audit quality in the most efficient and effective way possible.
So that's more of like an exchange of best practices.
Yes, from that perspective.
Thank you.
I think we had a question here first.
I guess on this topic, I'm just wondering, is there really a controversy here? I mean, I understand discussion today, but it seems to me, at least I don't see any controversy here at all. And I just, I'm pretty direct always. I just want to commend, frankly, the PCAOB for over the years with, prior and current administration, so to speak, taking action here and being very forceful because it is a, it is a benefit to the U.S. in terms of our, processes we have here. And in fact that, so many companies want to list in the U.S. versus the other locations. And so I don't see, on this one, I'm just curious, do you have pushback Is there controversy? Because I can't, in my own sense, see what see any controversy should be on this item.
No, I mean, the cooperation we get, the work gets done. I mean, we hold, like I said, these firms to the same standards, and these international regulators greatly assist with that. They do. Thank you. Gary?
I just wanted to share with the IAG members, and I think the board knows this. I was added to the investor working group for IFER, the International Forum of Independent Auditor Regulators this past year. I think I was put up by a couple people in this room. And I was excited because it was in Berlin. The meeting was in Berlin this year. And so that was awesome. And the meeting happened 3 days after Liberation Day. I really walked in with the target on my back for sure. But what was great about that meeting is it really highlighted a couple things. These international regulators are trying to do the exact same work that we're trying to do, but they really focus on what's going on at the PCAOB, and they take their cues from what y'all are doing. And it was clear to me that they are fast followers on the PCAOB initiatives. But as Sandy talks about kind of the impact of audit quality worldwide, the PCAOB's reach is really a lot further than I appreciated going in. So anyway, I thought that was really awesome.
Yeah, thank you.
Thank you. As I think Sandy mentioned earlier, the SEC has a concept release related to foreign private issuers that CII and many others have commented on. And within that project, there's some concerns raised by commissioners and others about Chinese companies, including Chinese companies that are incorporated in the Cayman Islands. There is some academic evidence suggesting that if you have weaker shareholder rights under corporate law, that can be correlated with poorer reporting. So there's that issue, the corporate law, Cayman Islands. And then CI just put out a report, an updated report we issued a number of years ago about Chinese variable interest entities and a risk to investors related to that structure. And I think the SEC did receive more than one comment letter in connection with the foreign private issuer concept release around that issue as well. So my question is about your data. If I want to look at your deficiency data and identify how Chinese VIEs or Chinese companies incorporated in the Cayman Islands or other companies incorporated in the Cayman Islands, is there a way I can identify through your data whether there's a greater or lesser deficiency rates for audits of those companies?
So I think the first thing you would need to do is to go and look at the firms that are auditing those Chinese issuers that you mentioned. And if you do that, then you will know, of course, we do not disclose which issuers that we are inspecting. However, if you look at the firm that is performing the audit, you would be able to see our inspection report on that particular firm. And you can pull the data easily from our website of which countries or which firms are in, say, China or Cayman Island or whatever it is. And from there, you could see what the deficiencies would be. We don't name the individual issuers, consistent with everything else, but I would tell you that our inspections in China and our inspections of, say, any issuer that is incorporated somewhere else are consistent, meaning that we identify the risks, We look at the risk areas. We do understand that there are different risks in different, I'll say, industries, and VIEs is a particular item in certain jurisdictions. And so that's what we focus on, are the risk areas. So those, of course, would be subject to our inspections. However, we don't set the corporate disclosure rules. We don't set the requirements for FPIs and who's going to file and not file. So we have to follow what's in our scope, and that scope is the auditing standards. So that's what we're looking at. That's what we're inspecting against. That's the bar. If a new rule comes out, if a new disclosure rule comes, then we will again look at that, because we do look at what's being filed under the 20F, under a 10K, or whatever the case might be. But we are limited to what we can look at in any issuer, no matter where it's at. But we do, presentation disclosure is really important, so it's part of what we look at also. You might see during our presentation, we do cover some of this, so we might be duplicative, but
It might be all over, but this is a good discussion, so we'd rather
Yeah.
proceed this way.
So on your site or on the international site, is there a listing by country or geography of audit firms that have sort of met your standards, cleared the basic threshold versus not?
You can sort on the inspection reporting page. You can sort by country. I think you can sort by the number of Part 1A. So I'll interpret kind of what you're asking as being there would be 0 Part 1A findings. So you can see, we would disclose, we inspected X number of audits and we found no instances. So that's one way to get at that information.
And also our registration page itself, you can pick a country, any country you want, and ask for all the firms in that particular country. And if you select on one of those, then you can see when we last inspected them, if they a link to their inspection report, that if the information, if their quality control criticisms were made public, there's a link there. But as I think Christine mentioned earlier, we have been working with several of the other offices and divisions of the PCAOB to enhance some of that data that's available. I think as we're all moving towards different uses of technology, the innovation of that, then that's all being looked at how do we provide that more effectively.
The reason I asked, I was for a number of years involved in an entity that was investing, it was a multi-strategy fund investing specifically in developing markets and economies. And it never occurred to me, but a logical first step in the analysis of any potential investment opportunity would be to look at the auditor.
Yeah.
And if the auditor is red flagged, then that's probably the point in the decision tree where you stop.
Yeah, that's right.
And whether it's a foreign country or an actual foreign country that's a developing market, that would be a really logical place to start your analysis. And it's not something that we did, but something that maybe you could also encourage. If you want to know, are you an investor in, looking overseas, as more people do look to invest in those markets? Where does your analysis begin? Maybe you want to start with that first step of finding out whether the numbers themselves, you have reason to believe that the numbers themselves are reliable.
Maybe I'll say that I'll encourage all of you around the table to do that also, because during an inspection, we do have a lot of access to the firm itself and obviously the non-US regulator, but we do not go to the public companies themselves. We do not interact with the public company, the audit committee on a non-US perspective, or any of the investors. So we do our best to try to get all that information out there. And that's why we try to work on those spotlights and audit focus materials to be able to do that. But you're absolutely right. That's the very first beginning. And if you look at the inspection report, not all inspections are created equal in what they're reporting, because some firms are doing better than others. But if you look at the first even page of an inspection report and says that they have 3 issuers and we looked at 3 issuers and we have Part 1A findings and 3 issuers, then that might tell you a little bit about the quality of that particular firm. And again, not that the firms can't get better, because we spend a lot of time in remediation also with the non-US firms, but it's a good question. And
Yeah,
that's a
just
good-
how is it logically not your first step to make sure that anything you're looking at going forward is reliable?
That's right.
Steve, just to add, we do periodically talk to short sellers and some of these analysts, and they have indicated that they look at the auditor, and if the auditor is not credible, then that's where, you know, all the red flags start to show up. Yeah, yeah.
So there is that, and some of my own research several years ago, which shows this, you know, the effects are pretty significant. So a company whose auditor was inspected by the PCAOB and has a Part 1 finding, the reverse way, does not have a Part 1 finding, they're able to increase their investments and capital expenditures. I want to say, if I remember the estimates correctly, somewhere between 9 to 10% of what it was before the inspection. And they're able to raise additional capital as well. And for the auditors, so in foreign countries, some auditors are inspected by the PCAOB, others are not, right? So the auditors who are inspected by the PCAOB and receive clean inspection reports, their market share increases once the inspection report is made public. So to your point, this information is used by investors.
Sorry, this is a great discussion. So actually, it's more than what we were hoping for. In the interest of time, though, I'm trying to think about how we can maybe fast forward through some of these materials and hit on the highlights that maybe we haven't covered. Just let me know if there are questions. Just very quickly, only because I mentioned year over year, you might not, we won't likely have the same composition of non-US firms because currently they're all auditing less than 100 or less issuers. So they're not required to be inspected every year. How they're required to be inspected at least every 3 years. However, we do have situations where we accelerate them and we inspect them earlier than every 3 years. And one case, you know, in outside the US might be because we want to align our work with the timing of a non-US regulator. Let's see, on slide 7, maybe I'll just hit a couple highlights on the inspection process because this really sets it out. And maybe if there were key takeaways for you to understand is regardless, like I said, of where the firm is inspected, they are subject to all of the same processes. There is no difference in how we approach them. I'll come back to the how. In our inspection processes, and our objective, right? We're there to assess compliance with the same set of PCAOB standards and rules. How we might go about doing that could vary if there is a foreign regulator present because we work very collaboratively with them. And that how might be, say, for example, in the pre-planning activities, we may coordinate with them the timing of the inspection, whether and when we're going to be there on site together. Or in drafting or finalizing our inspection report, we do that, but how we might get that report to the firm will be coordinated through a foreign regulator. Those are just some examples, but otherwise what we do and the purpose does not change regardless of location. The next slide, we may have touched on this a little bit, or Julie did, talking about the global network firm, non-US affiliates versus the non-affiliate firms. So those affiliated with the global networks tend to have a little bit better results. They have access to the global network firm resources, whether it be the same methodology, the same technology, which is very different from the non-affiliated firms. So, and Julie's already pointed out, we recognize that and we try to do more to help these firms, help them understand kind of where common areas of deficiencies are. We put out videos, help them through remediation and whatnot. But generally speaking, these firms, because they're smaller, they have few issuers. In some cases, they only have 1 or 2. And so we kind of keep all of that in mind. It doesn't, again, change what we do, but it may just be that we're tailoring our inspection to the size of the firm. I'm going to keep moving forward. Yeah, let me spend just a couple of minutes here because this is where some of the differences come into play. If there's a foreign firm that does request us to work with a non-US regulator, they would make a request under Rule 4011 to our board, and then we would work with the board to determine whether and if so, to what extent under Rule 4012 we could work and rely on, if at all, rely on the work of a foreign regulator when performing our inspection of the firms. Our Office of International Affairs works very closely with us in kind of the pre-planning well in advance of inspections. Julie may have mentioned the statement of protocols, the agreements we need for sharing of confidential information. A lot of work goes into the pre-planning, so to speak, and our Office of International Affairs is there up front as well as throughout the inspection and after to assist us along the way, complying and understanding those agreements. But generally speaking, our non-US inspections work in two ways, and we've been performing these inspections since 2005, so I think it's 20 years now. And we will either perform the inspection in coordination, so to speak, with the non-US regulator, but it's referred to here as a PCAOB only. So there we're just coordinating the timing. They may be in the field as the same time as our inspectors. They may not be, but that interaction is certainly way different and much greater in the second category here, where we're inspecting jointly. We have joint inspections with foreign regulators in certain jurisdictions. In those cases, where it could be in the field side by side at the same time, sometimes looking at the same files, looking at the same quality control, the firm system of quality control work. So there's very significant collaboration in that second category. In all cases, of course, going back to some of those processes, we do issue our own inspection reports. So, and that's again, like any other firm throughout the globe and our inspections. I'm going to move on very quickly and then I'll hand it over to Julie. Nope, I think we're good there. Okay. All right, Julie. In the few minutes I didn't save you.
No, it's okay. My PCAOB colleagues would tell you I could spend hours and hours and hours talking about non-US inspections. So I'm just going to try to be really quick here. And maybe if we could go to that next slide, please. So we put this indicative timeline up. This is important for us. It's consistent when we do triennial inspections, no matter where we are at. But we put this here so we could just talk about a few places where our coordination with non-US regulators is really critical, and that's at the beginning part of what we're doing. Now, we do follow our confidential sharing agreements if we have those, but in our planning stages, for example, this is the place that we start where we're reading all that publicly available information like the 10Ks, the 10Qs, the 20Fs, press releases, short seller reports, analyst reports. But this is also a place where we're looking at what our non-US counterpart is doing, looking at their reports, having the discussions with them where their concerns are, and having the discussion about how we can inspect together effectively. We send a notification letter out, and that notification letter is important, but it also communicates that we expect to receive a complete set of work papers, including hard copies of any documents or anything else, and those must be provided to us, to our inspectors on the first day of field work, and this is non-negotiable. We expect to have all of that information available. And then while we're in the field, we may be reviewing some of the same engagements, some of the same quality control areas with the non-US regulator, and that process goes throughout the entire part of the inspection, through the fieldwork piece, and even into our remediation aspect of it. If we can go to the next slide, the points I would like to recommend or mention here is that, outside of the US, a lot of the firms are auditing for both PCAOB-based reports to be filed with the SEC and under the auditing standards of the jurisdiction for statutory reporting. And sometimes this can lead to additional auditing requirements for the firms, but the statutory audit work cannot be incorporated into a PCAOB audit because the statutory audits usually have hold harmless agreements and they're not allowed into the PCAOB roles. However, the PCAOB audits can be incorporated into the statutory work to leverage the work that the auditor needs to do. So our work is not duplicative, it actually is complementary in the process. And while we're in the field, the non-US regulator is also looking at the same areas that we are, but we're looking under our respective jurisdiction and our respective standards. There's a lot of information that's complementary, and we use that to our advantage to not put too much burden on the individual firms. We do have initial meetings with the firm, each individual firm's CEO, their head of audit, their general counsel, and other individuals who are responsible for the quality control areas. In addition, there are certain areas that we look at on every inspection that we go on, especially from a non-US perspective, and those include things like independence, fraud, audit findings, the required audit committee communications, the auditor's report, EQRs, and audit documentation. And where appropriate, we also walk through the process of cash and the confirmation of cash and other receivables. Maybe just
Could I just ask a quick question? You say audit committee communications and you meet, but I don't see where you ever say you meet with the audit committee.
On a non-US perspective, we do not meet with audit committees. Sometimes that is because of the jurisdictional aspect. Another non-US regulator may not have the statutory perspective to do that. And generally what we find is if you have an audit committee, that member who is not comfortable speaking to us in their own particular language, they prefer not to meet with us. We are looking at in some other jurisdictions on how we can work collaboratively on piloting some discussions with audit committees, but we don't have that worked out yet. We do, though, offer on the US side to meet with audit committees, but it is something that we've talked jointly with our non-US counterparts on how can we look at doing something together with audit committee members. And so maybe here, let me just say from a reporting perspective, things are very similar. We have the same process that we go through with our US inspections, so not much different there. The only difference between what we do from a non-US perspective is we do, based upon our confidential sharing agreements, some inspection reports need to be included or routed through the non-US regulator. And we also, both of us, look at both of the findings that we have to make sure that we understand what are the similarities and what are the differences, and do those make sense, especially in the quality control area or in individual engagements that we've looked at. This you would see most often. Our 30-day process to get inspections back and the board to review that does not change because we're doing non-US inspections. That all remains the same. And if you look at the individual inspection report components, those are the same also in all of our reports. It's just that in some aspects of it, we would have very similar comments to a non-US regulator, and in some aspects we will not. And I'm just conscious of time, so maybe I'll try to stop there and see if there's any other comments. And I know we have other information in the deck, but always happy, as we said at the beginning, to take any other questions, or I'm sure Saba could route any questions that you may have offside, but I know it's been a long day, so I'll stop there.
Thank you, Julie. Oh, I see Jeff. Jeff has a question.
Thanks. Sorry to hold up. Going back to China again, since it's such a common topic here in Washington. So if someone were to say that your inspections with respect to Chinese firms are less rigorous than your other inspections, can you just talk about that
And the process.
allegation that some have made?
I would say that our inspections are consistent across any firm that we go to. Again, we, as I mentioned at the beginning, we do send our notification letters out. We do the work. We look at the risks that are out there, same as we would do for any inspection that we go to. And we have the same demands on any firm that we inspect in China. No matter where we are, if we're in any other part of the world, we would have those same demands on them. We don't change just because we're in a particular country. What we do is coordinate with the non-US regulator, if there is one, and we do abide by the statement of protocols that are in each jurisdiction to make sure that no one is tripping over any legal frameworks that they have, but our inspections are exactly the same, and we have the same access that we have anywhere else to be able to make those selections, pick the engagements we're looking at, look at the focus areas, and we hold everybody at the same level, again, no matter where we're at.
Thank you.
Just one final thought, Satyam.
I don't know if this is readily measurable, but do you find that the level of cooperation you get from non-US regulators is higher because the PCAOB is a nonprofit and is not technically a US government entity? Is that a sort of a source of strength in those discussions and ongoing negotiations?
I wouldn't necessarily say, it's hard to measure. However, what I will say is because of the fact that we're a nonprofit and some of the aspects in our statute, then we are able to get information directly from the firm because we are not a governmental agency. So the information that is shared under, 105B5. If we were a governmental agency, then I think we would have different challenges with the individual respective jurisdictions. But when you're sharing information with a nonprofit with different aspects of it, it does help us, I think. I don't know if I could go through and say 5 out of 10, but it does help us in that space. There would be other challenges, I think, especially in the protocols and the like that are there. So, and every non-US regulator also has different responsibilities. Some are capital markets regulators, et cetera. So those kind of play into each individual country that we go to and what they can also be able to share with us.
Just a quick comment. People are sort of alluding to this. I think the Holding Foreign Companies Accountable Act has made the cooperation we're talking about today possible. So when we talk about China, that actually really changed the dynamic because before that, we were not able to go in, inspect audit firms of companies listed on American stock exchanges that were Chinese, for example. But that's true of other countries that, so hope that's helpful.
This has been really thoughtful and engaging session. Thank you, Julie. Thank you, Christine. And thank you to all the IAG members as well as our outside experts for very insightful discussion throughout the day. We really appreciate the time, travel, and your unique perspective that you contribute. I'd like to invite Amy, the IAG co-chair, for final closing thoughts.
Thanks, Salva. I just wanted to say thank you to everyone who's here. Thanks to people who are listening online, the PCAOB board for their engagement and attention and interest in our perspectives. It's really helpful for us to be able to sit with you and try to collaborate on some thoughtful issues. And Saba asked me to remind everyone in the room as well as people online that the deadline to submit applications to be on this investor advisory group is September 29th. And if you have people in mind that you think would be good candidates for our group, please give them to Saba and she will contact them and tell them how much fun and engaging this group is. So I'll turn it back to Saba.
I thought I was the other.
Thank you, Amy, and thank you, everyone. With that, meeting is adjourned. Thank you.